Good evening, and welcome to Global Economic Pulse. I am Boni, and tonight we bring you what may be the most consequential economic story of 2026 so far. Over the past 96 hours, the global economic landscape has been fundamentally altered. The United States and Israel launched a coordinated military campaign against Iran, and the reverberations are being felt in every corner of the world economy. From the trading floors of Tokyo to the oil fields of the Persian Gulf, from the Federal Reserve's corridors in Washington to the European Central Bank in Frankfurt, decision makers are scrambling to assess the damage and prepare for what comes next. Tonight, we will cut through the noise, examine the data, scrutinize the expert opinions, and present you with the scenarios that matter most for your financial decisions. Let us begin with the epicenter of this crisis, the energy markets. Brent crude oil surged to $79.40 per barrel on Monday, an increase of $6 or 8.5% in a single trading session. To put this in perspective, oil was trading at just above $60 in January of this year. That represents a 32% increase in barely 2 months. But the headline number only tells part of the story. European natural gas prices exploded by 50% on Monday alone after Qatar's state-owned Qatar Energy announced it had halted production at 2 facilities following Iranian drone attacks. The benchmark for European gas prices hit a 3-year high. This is not merely a supply disruption. This is a potential structural shift in global energy markets. The Strait of Hormuz, through which approximately 20% of the world's oil supply and 20% of global natural gas passes daily, has become the focal point of this crisis. An Iranian Revolutionary Guard commander declared the strait closed and threatened to set ablaze any ships attempting to navigate the route. Tankers are already declining to use the passage, and critically, some shipping companies are also avoiding the Suez Canal as the conflict engulfs the wider region. Insurance companies are refusing to provide coverage for vessels transiting these waters. The implications for global supply chains cannot be overstated. This is not just about oil. Every container ship, every cargo vessel, every tanker that would normally pass through these waters must now find alternative routes, adding weeks to delivery times and billions to shipping costs. Goldman Sachs has modeled a worst-case scenario in which the Strait of Hormuz is completely blocked for 1 month. Their analysis suggests oil prices would jump by an additional $15 per barrel, though they note this could be partially mitigated by ramping up supplies via alternative routes. The OPEC Plus producers cartel has signaled a modest increase in quotas. But let me be direct with you. A modest increase in quotas will not compensate for the loss of 20% of global oil transit capacity. The math simply does not work. What Goldman Sachs is not telling you is that their worst-case scenario may actually be the base case if this conflict extends beyond the 4 to 5 weeks that President Trump has suggested. Now let us examine what this means for the global stock markets, because the carnage has been significant. In Europe, the Pan-European Stocks 600 index fell 2.9% on Tuesday, extending Monday's 1.6% decline. Germany's DAX plunged 3.3% to 23,935. France's CAC 40 dropped 2.2% to 8,207. Britain's FTSE 100 declined 2.2%. Banking stocks across Europe fell 4.2%. Insurance stocks dropped 4.1%. Even the European Aerospace and Defense Index, which you might expect to benefit from wartime spending, shed 2.2% after an initial rally. Travel and leisure stocks plummeted 2.4% as airspace closures forced airlines worldwide to cancel thousands of flights. The devastation in Asian markets was even more severe. South Korea's Kospi, which had been the best-performing index globally this year, plunged 6.5% in a single session. Japan's Nikkei 225 fell 3% to approximately 58,057. Australia's ASX 200 dropped 1.5%. China's SSE Composite fell 1.3% before recovering slightly. Korean air shares collapsed more than 9%. Japan Airlines sank approximately 6%. What is particularly telling is the divergence between Asian and American markets. The S&P 500 closed essentially flat on Monday, while the Nasdaq Composite actually edged up 0.36%. This divergence reveals something important. American markets are betting that the United States, with its domestic shale oil production and strategic petroleum reserve, is better insulated from this shock than energy-importing nations in Asia and Europe. Whether that bet proves correct remains to be seen. Let me now turn to the critical question of central bank policy, because this is where the real long-term economic consequences will be determined. Before this conflict erupted, markets were pricing in a 49.6% probability of a Federal Reserve interest rate cut by June. That probability has now collapsed to 30.7%. Some analysts suggest the probability of any rate cut in 2026 has dropped to just 20%, down from nearly 50% last week. Former Federal Reserve Chair Janet Yellen, speaking at the S&P Global TPM 26 shipping conference, stated plainly that the war risks both higher United States inflation and slower growth, and, in her words, puts the Fed even more on hold, more reluctant to cut rates than they were before this happened. This is a remarkable statement from someone who understands the Fed's internal deliberations better than almost anyone alive. The implications are profound. President Trump has been declaring inflation tamed and pushing aggressively for rate cuts. The Iran conflict threatens to undermine his central economic narrative entirely. A $10 increase in oil prices, according to CNBC's analysis, would translate to roughly a 0.2 percentage point rise in inflation and a 0.1 percentage point drag on economic growth. If oil reaches $90 to $100 per barrel and stays there, Capital Economics estimates that inflation in developed markets would be up to 0.8% higher than expected. At that level, central banks would not merely pause rate cuts. They could be forced to raise interest rates once more. The European Central Bank, which left its key rate unchanged at 2% in February and forecast 1.9% average inflation for this year, is now facing an entirely different calculus. Eurozone inflation already rose unexpectedly to 1.9% in February, up from 1.7% in January. With energy prices surging, that number is almost certainly heading higher. The Bank of England faces perhaps the most acute dilemma. Before the conflict, markets were pricing in an 80% probability of a rate cut at the bank's next meeting on March 19th. That probability has now fallen to 69%. The United Kingdom, as a net energy importer, is particularly vulnerable to this shock. Rachel Reeves's fiscal plans could be significantly impacted, with the Office for Budget Responsibility likely to revise its growth and borrowing forecasts. Now, I want to take you deeper into the analysis that mainstream coverage is missing. The real story here is not just about oil prices. It is about the fundamental restructuring of global trade routes and supply chains that has been accelerating since the COVID pandemic and Russia's invasion of Ukraine. We are witnessing the third major supply chain shock in 6 years, and each successive shock is hitting an increasingly fragile system. The Jebel Ali port in Dubai, one of the world's busiest container ports, temporarily suspended operations. This port handles trade for the entire Gulf region and serves as a critical transshipment hub for goods moving between Asia and Europe. Its closure, even temporarily, sends ripple effects through supply chains that will take weeks to resolve. What the mainstream analysis also overlooks is the secondary and tertiary effects on emerging markets. An analysis published today highlights that the oil shock will strain emerging markets well beyond inflation, creating broader pressures on external balances. Countries like India, Turkey, and South Africa, which are major oil importers with current account deficits, face a potential balance of payments crisis if oil prices remain elevated. The ING Group's analysis, drawing on European Central Bank research from December, showed that a 14% increase in oil prices would push up inflation by 0.5 percentage points and could reduce GDP growth by 0.1 percentage points. We have already exceeded that 14% threshold, and the conflict is only 4 days old. Let me now present you with the scenario analysis that I believe every serious investor and decision maker needs to consider. I have synthesized the work of Carlyle Group, Natixis, Oxford Economics, and Capital Economics to construct 4 distinct scenarios with their associated probabilities. Scenario 1, which I call the swift resolution, carries approximately a 15% probability. In this scenario, Iran's remaining military capability proves limited. The regime collapses or sues for peace within 2 to 3 weeks. Oil prices retrace to $65 to $70 per barrel by April, and the economic impact is minimal and short-lived. The Fed proceeds with rate cuts as previously expected. This is the most optimistic outcome, and frankly the least likely given the asymmetric capabilities Iran has already demonstrated. Scenario 2, the managed escalation, carries approximately a 35% probability. This is closest to the Carlyle Group's base case. The conflict continues for 4 to 8 weeks with a protracted asymmetric campaign, including cyber attacks, terrorism, and proxy forces. Oil prices stabilize between $80 and $90 per barrel. The Strait of Hormuz experiences intermittent disruptions, but is not permanently closed. The Fed delays rate cuts until late 2026 or early 2027. Global GDP growth is reduced by 0.3 to 0.5 percentage points. Scenario 3, the regional conflagration, carries approximately a 35% probability. In this scenario, the conflict broadens significantly. Iraq, the second largest OPEC producer, becomes destabilized. Proxy forces attack energy infrastructure across the Gulf. Oil prices surge above $100 per barrel and remain elevated. Shipping lanes are severely disrupted, insurance costs spike, and global production networks are impaired. The Fed is forced to raise interest rates. United States growth turns negative in 1 or 2 quarters. European and Asian economies enter recession. Scenario 4, the global economic crisis, carries approximately a 15% probability. This is the tail risk scenario that Natixis outlined. The conflict becomes a full-scale regional war involving multiple state actors. The Strait of Hormuz is completely blocked for an extended period. Oil prices exceed $120 per barrel. Global supply chains collapse. The United States deficit explodes as war spending, which has already reached $31 to $34 billion, escalates further. A top budget expert has estimated the total cost to the American economy could reach $210 billion. Multiple major economies enter recession simultaneously. Central banks face the impossible choice between fighting inflation and preventing economic collapse. The cryptocurrency markets offer an interesting counterpoint to this analysis. Bitcoin initially surged to $68,600 on Monday, briefly touching $70,000, as some investors viewed it as a hedge against geopolitical chaos. Arthur Hayes, the former BitMEX CEO, argued that the Federal Reserve will eventually be forced to print money to fund the Iran war, which would send Bitcoin significantly higher. Strategy, formerly MicroStrategy, purchased $204 million worth of Bitcoin through the strikes. However, Bitcoin subsequently plunged as the reality of a prolonged conflict and tighter monetary policy weighed on risk assets. This volatility perfectly encapsulates the market's uncertainty about which scenario will ultimately prevail. There is another dimension to this crisis that demands our attention: the trade war overlay. Even before the Iran conflict erupted, the global trading system was under severe strain. The Peterson Institute for International Economics published analysis today showing that China has effectively stopped buying United States exports. Their research indicates China would have purchased nearly 60% more goods from the United States in 2025, if not for Trump's tariff wars. Europe is testing Trump's patience with delays on a trade deal, while the existing agreement maintains a 15% duty on most European Union products. The Bank of Canada, which holds its rate at 2.25%, has explicitly acknowledged that the Canadian economy continues to adjust to United States tariffs and the new global trade landscape. Deputy Governor Sharon Kozicki warned that sometimes rate hikes are needed even when the economy is weak, a statement that perfectly captures the impossible position central bankers now find themselves in. The gold market tells its own story of fear and uncertainty. Gold futures surged 4% to above $5,400 per ounce on Monday, driven by safe haven demand. However, in a counterintuitive move, gold subsequently fell 4% as the strong dollar and expectations of higher interest rates undercut the safe haven trade. Silver reached $94.71 per ounce. This whipsaw in precious metals reveals the fundamental tension in markets right now. Investors want safety, but the traditional safe havens are sending conflicting signals. The dollar is strengthening because of safe haven flows, but a stronger dollar and higher rates typically suppress gold prices. This is the kind of market dislocation that creates both enormous risks and enormous opportunities. Let me also draw your attention to the European manufacturing data released this week, which provides crucial context for understanding where the global economy stood before this shock hit. The Eurozone Purchasing Managers Index showed Italy at 50.6 and France at 50.1, both returning to expansion territory. New orders rose at the fastest pace since April 2022, driven by infrastructure and defense spending. Germany's defense spending surge, in particular, was beginning to provide a meaningful boost to European industrial output. The question now is whether the energy price shock will derail this nascent recovery before it has a chance to take hold. The United States labor market data provides another critical piece of the puzzle. Weekly jobless claims stood at 212,000, up 4,000 from the previous week, indicating that layoffs remain relatively low. In January, the economy added 130,000 net new jobs, and the unemployment rate declined to 4.28%. The February employment report, due on Friday, is expected to show 55,000 new jobs and a 4.4% unemployment rate. These numbers suggest the labor market was stabilizing before the Iran shock. The question for the Federal Reserve is whether the inflationary impact of higher energy prices will outweigh the potential cooling effect on employment and growth. As I bring this analysis to a close, I want to leave you with the most important insight from tonight's episode. We are at an inflection point. The global economy was already navigating the treacherous waters of trade wars, persistent inflation, and the aftermath of the most aggressive monetary tightening cycle in decades. The Iran conflict has introduced a new variable that could amplify every existing vulnerability. The decisions made by central bankers, political leaders, and military commanders in the coming days and weeks will determine whether this becomes a manageable disruption or a defining crisis of the decade. For investors, the message is clear. Reduce exposure to energy-dependent sectors in import-heavy economies, maintain adequate cash reserves, and watch the Strait of Hormuz like your portfolio depends on it, because it does. For policymakers, the challenge is equally stark. Every tool in the economic toolkit may be needed, and some tools that were thought to be retired, like emergency rate hikes and strategic petroleum reserve releases, may need to be dusted off sooner than anyone expected. I am Bonnie, and this has been Global Economic Pulse. The data does not lie, but it does demand interpretation. Stay informed, stay analytical, and above all, stay ahead of the curve. We will be back with a full update as this crisis continues to unfold. Good evening.